like we mentioned with McDonald's over the years. What are some features of common and preferred stock? Common stock is simply equity without any priority for dividends or priority in bankruptcy. It's what you and I generally buy. Very rarely do we buy preferred stocks. Occasionally you may buy one. It falls under the rule of corporate democracy, one share, one vote. He who has the shares makes the rules generally. Preferred stocks, on the other hand, have a dividend priority. They get paid first. Fixed dividend usually, and kind of similar to a coupon rate, but sometimes no voting rights with these preferred stock. So preferred stock has preference over common in payment of dividends and distribution of assets in bankruptcy. So that might be an occasion when you want to buy preferred stock. Cumulative voting is kind of a new way of voting at the annual meeting. It's important to distinguish the company that you buy stock in. Do they use cumulative voting or straight voting? Are you a minority shareholder? Can you still get a seat on the board of directors if you're a minority shareholder who has fewer shares than a majority shareholder? And the answer is yes. Total number of votes that a shareholder may cast is the number of shares owned. And 1 over n plus 1% plus 1 share is what you need to acquire, number of shares to acquire, to guarantee you a seat on the board of directors. So let's look at an example of how to do that. You have Smith and Jones. Smith is me. I'm a minority shareholder. I only have 20 shares. You are Jones. You have 80 shares. You're a majority shareholder. Now the question is, how many shares does Smith need to guarantee himself, that's me, a seat on the board of directors? I need 1 over n plus 1, where n is the number of directors to be elected. In cumulative voting, we vote them all together, all at once, all 4 directors. With straight voting, we do them one at a time. So if you have more shares than me, you win on every seat. But with cumulative voting, we do it differently. You need 1 over n plus 1% plus 1 share to guarantee yourself a seat on the board of directors. So n in this case is 4. So 1 over 4 plus 1 is 1/5. Change that into percentage, 20%, times the number of shares outstanding. There are 400 votes outstanding. So 20% of 400 is 80, plus 1 share is 81 shares. So if Smith has 81, that's how many he needs to have to defeat Jones. Jones would vote 81, 81, 81, and then would only have 77 left. And therefore, Smith would win and would guarantee himself a seat on the board of directors. So 1 over n plus 1% plus 1 share will guarantee you a seat. So if you're Carl Icahn looking to take over a board, or Elon Musk looking to take over Twitter, you have to figure out how many shares you would need to guarantee yourself a seat on the board. Straight voting is simple. It is 50% of the stock available outstanding plus 1 share. With cumulative voting, you need 1 over n plus 1% plus 1 share. So it's a little bit different. Staggering happens in many companies. We stagger the number of directors to be elected to avoid takeovers, hostile takeovers. So if you elect 9 directors, you only need 1/10 of all the shares outstanding plus 1 share. If you only elect 2 directors every year, you need a full 33 1/3% of all shares outstanding plus 1 share. So you may want to think about how you stagger your directors' election times over the years. If you want to set up a proxy fight, if you're unhappy with management and leadership of the company, you can start a proxy fight via proxy vote. So these statements come to you in the mail or on your computer. Nowadays, you can vote your shares at proxyvote.com. You don't have to go to the annual meeting, and you can start a proxy fight using these proxy statements. Proxy is just giving the authority for someone else to vote your shares. Back in 2008, Microsoft made an unsolicited bid to buy Yahoo for $31 a share. Yahoo believed it was undervalued and turned them down. They declined the offer. Microsoft withdrew. Carl Icahn launched an effort to remove the board of directors through a proxy fight. And in 2016, Starboard Value Limited Partners attempted to overthrow the entire board of directors due to poor financial performance. And this can happen. And again, they will start a proxy fight using the proxy form that's sent out every year. Proxyvote.com is where you can find these, and you'll need a separate special number to log in and vote your shares. Typically, with all the shares of stock I've bought in my life, I've never attended an annual meeting. Any voting I've done has been online or through the mail, filling in a little Scantron sheet, or voting on proxyvote.com. Primary reason for creating many classes of stock has to do with control of the firm. So some boards of directors want to control, or some families want to control their grip on a company, Ford being most notable. The Ford family only owns 3.9% of the votes, the actual shares, but 40% of voting power. You can see a young CEO, Brian Roberts, out of Comcast, only has 0.4%, but a full 33.33% of the voting power. So enormous voting power vested in one man or one family in the case of Ford Motor Company. So sometimes companies will issue Class A stock, Class B stock. Google has done that. Class A shares are held by you and I. Each share has one vote. Class B shares are held by company leaders like Brin and Page, and those Class B shares all have 10 votes of power with each of them. So Page and Brin have a significant say in the Google arena. Shareholders have the right to share proportionately in dividends paid. So one share, one per share dividend, 100 shares, you get 100 shares worth of dividends. I also get to share proportionally in assets remaining after liquidation and bankruptcy. After I sell my assets, pay my liabilities, and liquidate the company, if there's anything left over, shareholders get a share of the proportional share of that. And we get to vote on matters of great importance based on the number of shares that we have, usually done at the annual meeting or a special meeting in the case of a takeover. Dividends are payments made by the corporation to you, the shareholder, either in cash or stock. Unless the dividend is declared, it is not a liability. Once it's declared, it becomes a liability. Payments of dividends is not a business expense. Like corporate coupons or interest payments, dividends are paid from after-tax profits, and dividends received are taxable. So if you get a $100 check from IBM for dividends, you must pay tax on that as ordinary income. The IRS will watch for that, and they'll watch to make sure you pay your taxes on those gains. Preferred stock is stock with dividend preferred priority over common, and usually you get paid first. Usually these preferred shares have a stated liquidation value, like $100 a share, and it may be a 5% dividend yield or a $5 dividend paid each and every year. So it starts to look a lot like a bond. It's still a preferred stock. Preferred stock sometimes looks like a bond because it pays that stated dividend of 5%, kind of like the coupon, and it can carry credit ratings, and it's convertible to common stock some years. So very, very similar to a bond, but not a bond. It's a preferred stock. Cumulative dividends are carried forward as arrearage to a future year if they're not paid this year. If you have a cumulative dividend policy, a non-cumulative dividend policy will not be carried forward if they're not paid in a certain year. Cumulative dividends do indeed roll over from year to year. So with a cumulative dividend policy, the dividends carried forward to a future year, and non-cumulative dividend policy, we don't carry them forward if not paid in a certain year. And here's a graphic example of a dividend paid, cumulative dividend policy, dividend paid, non-cumulative dividend policy, but if not paid, and with a cumulative dividend policy, they'll be paid in a future year. With a non-cumulative dividend policy, they will not be paid or carried forward in arrearage. Cumulative dividends roll over to the next dividend pay year. Usually, both past preferred dividends and current preferred dividends must be paid before common shareholders can get anything. Unpaid preferreds are not debts of the firm, and holders of preferred shares are granted voting rights sometimes. That's happened at U.S. Air. When dividends weren't paid one year, they had some representation on the board of directors versus having that dividend paid. What is typical stated liquidation value of preferred shares? Usually $100 a share. What happens in a proxy fight? You get to vote your shares. You can try and replace management if you're not satisfied with their performance, and you get these votes via proxy. And what's the difference between cumulative and non-cumulative preferred dividends? Cumulative dividends roll over into the next pay period. Non-cumulative dividends do not.